Let's touch base with our special market voice, as we always do post-open. Nilesh Shah, MD of Kotak AMC, joins in with his perspective on the markets. Nilesh, it's great to have you on the show. Thanks very much for being a part of our 9th year anniversary celebrations. Nilesh, is my voice reaching you?
Yes, your voice is reaching me.
I was just welcoming you on the show. Thanks very much for taking out the time. We really appreciate the support that you've extended out. We've had a great association over the course of the last 9 years, and it's great that you could make time for us, given that we're celebrating our 9th year anniversary all this week.
I mean, in a simple word, it's my pleasure to be part of Rise India.
Oh, absolutely. So, what's the big Rise with India theme that you're studying about this summer? We are at such a crossroads, so to speak, given the kind of global macro headwinds that are there, and the rising cost of capital with rates going up back home. We started talking election, even though that's not a pet theme right now in the market's mind. But politics is gaining some mind space when it comes to sharing one's outlook into the future. You have oil to contest with, you have a currency weakness which is coming through, and of course on domestic turf as well, rates are going up. How is that shaping your market philosophy?
So one, clearly when time becomes tough, the tough needs to be going. In 2017 calendar year, India had relatively very good macros and probably little weaker micros. 2018, we have given up some gains on the micro side. Oil prices have risen, global interest rates are rising, domestic interest rates are rising, inflation is rising, liquidity is tight. There is definitely uncertainty about political situation post 2019. But against that deteriorating micros, we have solid improvement in micros. Businesses have started gaining momentum. The disruptive reforms of GST and demonetizations are now behind us. We have suffered the short-term pain of introducing them, but now the longer-term benefits are coming through. So slowly and steadily, we are reaching a stage where bottom-up businesses have started doing well. Monsoon is likely to be good, whereas top-down, some of the broad economic trends are going against us. This will keep market on a tenterhook. It will keep market on a range-bound fashion. Unless until one of the variable changes, markets are likely to remain range-bound.
Okay, but when you're talking about the markets being range-bound, are you saying that we will not perhaps see the markets react to that earnings support which was expected to come through in FY19, the signs of which we saw in the Q4 numbers? Because if you ask anybody on the street, they believe that the upside potential for the markets is really riding on the premise of the earnings cycle picking up.
Undoubtedly, at the end of the day, earnings will decide the trajectory of market. But my guess is that in 2016, 2017, we saw earnings not coming through and yet market going up in anticipation of earnings growth. 2018 could be a differentiator where earnings might come through and yet market may not go up because of the overhang of political situation. Over a period of time, once the politics will be behind us, then definitely earnings will support the market. But till such time those factors continue to weigh on the market, I don't think so market will be bold enough to take a universal direction which is up. It's more likely to be up, down rather than a straight line up.
So Nilesh, morning firstly, in this range bound scenario, do you sense this this volatility which is playing out, this dichotomy in the market where mid and small caps are doing one thing and the large caps are just 3% shy from their all-time top. Is this dichotomy going to remain, or do you sense that the two ends shall meet? Either the broader market weakness is going to rub off on the large caps, or the broader markets are going to catch up with the large caps and see a huge rebound play out?
So first we have to understand why small and mid caps have kind of suffered a lot. We took a view in somewhere in Jan mid. At that point of time, large caps were trading at 10-year premium to their last 10-year average price to book, whereas the mid caps were trading at about 25% premium and the small caps were trading at 33% premium. And mind you, we are only talking about the index. There are micro caps and mini caps within the stock market which are not part of the index. They were probably trading at 50 to 100% premium to their last 10-year average. This has all resulted into huge overvaluation in mini caps, micro caps, and probably some of the small caps. They needed a trigger for correction, and that trigger was provided by rising interest rates. That trigger was provided by tight liquidity. That trigger was provided by global tariff wars, or who knows, some other factor. But in reality, that correction was driven by prices moving way ahead of fundamentals. Now, on the micro caps, mini caps, they have corrected. The small cap premium has also come down to about double digit, just about 10-12% over their historical average. Mid caps are still higher at about 20% premium, and large caps are at about 5% premium. So clearly in large cap, premium over the 10-year historical average in terms of price to book is the narrowest and probably sustainable, which is why we are not seeing huge correction in large caps. In mid caps, we believe there will be differentiation. Some of the momentum mid caps where valuations are still expensive, they will continue to drift down. The selling pressure in those momentum mid and small caps is not yet over. We could see them drifting further down. However, some of the quality mid and small caps where valuations are now looking reasonable, we are seeing first signs of limited buying emerging. Maybe over next 60 days, they will start bottoming out. Not that they will start rising again quickly, but they will definitely start bottoming out. So this is time where you go towards defensive sector. This is time where you go towards large cap and quality. This is time where you still avoid momentum, and that's how the scenario is likely to pan out in the days to come.
Nilesh, before I dig more on which sectors and stocks you like, I want to talk about the currency, because that really is the big talking point. The fact that we're already sub the 68 to the greenback movement. I recall start of the month when we were chatting post policy, you said that money markets are in a comfortable zone. They've already priced in 2 more rate hikes from the RBI. Is rupee turning out to be a bit of an alarming zone for you, or would you say that at 68, 69, we're in fair value considering the emerging market currencies has fallen much more and there's a lot that the money market is pricing in any case?
So in terms of rupee, our view was throughout 2017 that we are a little bit overvalued based on capital flows. The flows were driving rupee towards overvaluation, and it was reflected in weaker exports consistently. Now rupee has corrected as some of the capital flows has reversed, and higher oil price is impacting our current account deficit. My guess is that balance of payment also may turn negative, and which will be reflected into weaker rupee. So to some extent, rupee's depreciation, while it might look year to date very high, if we take our 2-year, 3-year average, then it is still reasonable, and that is what is priced in by the FII investors as well as domestic people. My guess is that rupee depreciation will have both positive effects as well as negative effects. Negative effects will be felt in terms of inflation, because rising crude prices and other import will get reflected into our inflation numbers. It might also reflect into some of the debt FII outflows as they bear the brunt of currency weakness. However, the positive effect of rupee depreciation will outweigh the negative effects. One, exports could recover. Now there are lots of arguments about how our exports are inelastic to rupee, but in reality, whenever rupee will depreciate, some exports will start recovering, and some imports will become expensive. We run $52 billion official trade deficit with China. It's coming at the cost of small and medium enterprises in the country. Clearly, rupee depreciation will allow Indian manufacturers to compete with Chinese manufacturers. The dumping which China has continued in last couple of years will not be as easily possible as when rupee was at 64. The second advantage of rupee depreciation will be that we have some equilibrium in currency that will attract longer term FII investors that okay, we were holding back because rupee was overvalued. Now rupee seems to be fairly valued, so it's time to look at India. So overall, the benefits of rupee depreciation will be outweighing the negatives of rupee depreciation, and market will be comfortable at current level of rupee.
You know, your understanding of the banking sector is perhaps the best in the street, Nilesh. So give us your take on what's happening with the leadership transition with regards to two banks, ICICI Bank and Axis Bank. And I'm not asking you to get into the specifics here. I know you on a cursory basis touched upon that. And also give us your thought process on how you're viewing this whole PSU bank consolidation in the wake of the fact that, you know, you've had the biggest bank in SBI say we don't need any more associate arms to merge with. We've done our bit.
So on the consolidation of PSU bank, a merger will benefit only if 2 plus 2 becomes 22 and not 2 plus 2 becoming 4. Now we have seen that in PSU bank's merger, you are not able to retrench staff. In fact, many a times you try to, please the prodigal son. So in one of the previous cases, there was pension fund differentiation between two banks which were getting merged. And ideally, you should have brought, pension fund requirement together for all of them, which is the lowest common denomination. Instead, it was done in a manner where everyone benefited and the pension benefits were given as per highest common denomination. Now, such kind of merger are bound to fail because one, you are not able to retrench staff, you are not able to rationalize branches. Third, you have to please the prodigal son by providing higher retrenchment or pension benefits. The whole combination is not going to work. For PSU consolidation to be successful, they'll have to take a hard call on branch rationalization, on cost rationalization, on staff retrenchment if need be. Now, all these things will be taboo for the PSU banking system. So, my guess is that bank consolidation is not going to give any significant advantage. Probably better way will be to allow PSU bank administrative flexibility to run their businesses. Today, they have a lot of constraints imposed upon them. They have to service multiple objectives right from rural sector, agriculture sector, social sector, and also be profitable and competitive in stock market. This multiplicity of objective and lack of administrative flexibility has made PSU bank more dependent upon government for capital support rather than market. There are very few cases where public sector banks have been able to raise capital from the market, and whenever they have made an attempt, it is invariably bailed out by public sector financial institutions. So if we can create a model whereby PSU bank gets the administrative flexibility, whereby they are allowed to run their business without the multiplicity of objectives, that will allow them capital access from the public market, and that availability of capital will slowly and steadily build PSU banks like private sector banks or NBFC. So instead of merger and consolidation, giving them more flexibility to run their business, I think will be a right way to go forward.
With banks though, Nilesh, because now there seems to be clarity emerging on which way the future management is going to be headed, who's going to step in whose shoes. And yes, one can't deny that the valuations look pretty ripe considering how beaten down these names have been. Would you take a relook, or would nibbling into these names would be a prudent strategy?
So again, in PSU bank, we'll have to divide among PCA bank and non-PCA bank. Now in PCA bank, if they are not going to expand their denominator, which is the loans business, how are they going to make money? How are they going to create growth for the shareholders? They have fantastic liability franchise, no doubt about it. But unless until you put your deposits to work in terms of earning positive spread, you are not going to create value for your shareholders. So on non-PCA banks, we would remain, kind of underweight or will avoid them. On the PCA bank will kind of remain underweight or avoid. On the non-PCA banks, yes, selectively one can look at those banks, but again, the main important point is that their decision making should be free from external influences, and they should have administrative flexibility to run their businesses. Today, in a private bank, it's possible to find someone who has worked in treasury department for 2 decades. He has seen the up and down of the market, he knows regulations, he knows compliance. In PSU bank, it will be very rare to find a person who is in treasury beyond 3 years or 5 years. Now, how do you build expertise? How do you build that kind of long chain which gives you experience to face the volatility of the market? So somewhere PSU banks have to change their administrative framework to create value for shareholders.
Okay, fair point. Nilesh, to the point that you were earlier making, that the currency weakness comes with its set of good and the bad. Is the good going to continue to be great for IT companies, for instance, and will the tailwind continue to favor them, irrespective of the fact that they have been the leadership sector in the year gone by and some of these valuations are sitting at the all-time top?
So in IT sector per se, we haven't seen much correlation between currency depreciation and their margin.
Okay.
Invariably, customers price the contract keeping in mind where your currency is. So IT sector's re-rating, while in the short term might get influenced by currency depreciation, the longer term re-rating or longer term valuations will come based on how they are able to grow. And clearly within IT sector, despite all the great stellar work done by most of the IT companies, we seem to be not investing into the businesses which are future. In artificial intelligence, is there a great work done by an Indian company like they are doing it in code developing? Is digital something where we are cracking it like we were doing on application management and maintenance? Is cyber security something where customers can rely upon Indian IT companies? Is cloud computing, robotics, internet over things, are those cutting edge things where Indian companies are putting huge amount of effort? I think every IT company knows that this is the future, but the amount of investments which they have made is not probably appropriate. So the future will give value to those companies who have invested into this next frontier of business opportunities. People who remain into the let's say body shopping kind of work, they will get derated. So today IT sector per se has gone up, partly because they were defensive in nature, they were under-owned, they were undervalued. But now many of the IT companies are available at premium to their 10-year historical valuation, and we are not seeing the growth rate coming back. So in IT sector, be very, very selective, invest in those companies which are investing for future. Every commodity IT company is not going to create value for you.
No, that makes sense. As we draw towards the close for this discussion, Nilesh, what is it that you would be watching out for over the course of, let's say, the next 12 months? Yeah, because same time next year, the environment, I reckon, would be very different. So, the main influencing factor, according to you, over the course of the next 12 months, that will influence your investment philosophy as well.
So there are obviously factors like oil, monsoon, global interest rates, currency movements, tariff war, on which we have no control. What we will be focused upon is, one, the consumption theme, which will get supported over next 12 months vis-a-vis investment themes. The government in the run up to elections will be spending money, will be executing projects, and that will put money in the pockets of consumers, and they will come out to spend. And clearly consumption theme across urban and rural India, across millennials as well as senior citizens, will continue to deliver better return to shareholders, and we'll have to invest in those companies where the potential growth will be higher than what is priced by the market today, that will give us outperformance in this next 12 months of volatility.
Nilesh, such a pleasure having you on the show today. Thank you so much for taking the time out. Okay, that's the view coming in from Nilesh Shah, Kotak, on a whole host of views and opinions coming in from him, just about everything on the markets, to the currency, to the state of the economy, and of course sectors where you can place your bets.